home insurance can be a confusing topic, and since most people only buy 1 or 2 home insurance policies for their entire lifetime, it's hard to actually know what you're buying. My name is Sean and I make real estate easy. And in today's video, I'm going to simplify home insurance for you. We're going to cover what home insurance covers and how it actually protects you, the terminology, which are the tricky words they put in the policy, and I'll explain them in simple terms. And then finally, how to choose the right insurance. And I'll be giving you tips on how to find the best insurer. And be sure to stick around to the very end of the video where I give you my tips on how I find insurance for my own deals. So before we begin, let's talk about what home insurance is. Home insurance is a layer of financial protection so that if a major accident happens on your property, you're not the one who's going to be footing the whole bill. But in exchange for the protection against a major disaster, you're going to be paying a fixed amount of money every single year in terms of premiums. So as an example, let's say you spent your entire life savings and you finally bought a home and then a huge fire breaks out. If you didn't have insurance on that property, then you would be the one who'd have to pay for all of the repairs to bring that home back to its original condition. And for a fire, that can easily be upwards of $50,000. And if you just spent your life savings on buying that home in the first place, then you probably don't have $50,000 lying around to make that repair. And if you can't afford that repair, then that home is just gonna sit there for years as an empty shell. But if you had insurance, then an adjuster would come to the property, assess the damages, calculate the total cost, and then either give you a check to pay the contractor to fix your home, or they pay a contractor directly. Now, how much they're actually gonna pay depends on your policy. But as you can see, having this insurance is incredibly important so that you don't have to take on that huge financial burden by yourself. Now, home insurance typically comprises of 2 main parts, the dwelling and the liability. Dwelling refers to the actual property and all the damages that happen to the home itself. And your dwelling limit will tell you the maximum amount that the insurance company will pay you in the event of a disaster. So for example, if your dwelling limit is only $200,000, but the repairs are $250,000, then they'd give you $200,000, but you have to come up with the rest of the money yourself. And of course, insurance companies only pay for actual accidents. If you burned your own house down to get a check, then that would be considered insurance fraud and you would go to jail. But if there's a fire that broke out, a branch that fell on your roof, or a car that drove through your home, then the insurance companies will be able to help you with those costs. Now the other part is liability. Liability pays for accidents that happen to people that are on your property. So let's say someone tripped on your front porch and sued you for damages. Then instead of having to pay them directly for any of their medical care or trauma that they incurred, your insurance policy should be able to cover that up to your limit. So how much do you actually need? To determine the actual amount of insurance you need, there's a couple ways to look at it. Generally speaking, you should have at least $300,000 for your liability limit for most of your policies. This amount should cover most legal fees and judgment fees in case you lose your case. To be honest, if you have insurance on your property, most lawyers will look at your policy and settle out of court. So unless you do something really bad, you probably won't have to go to court yourself. Now, if you're getting a property with a loan, the lender will probably tell you that the dwelling limit has to be at least the amount of your mortgages. So if you're getting a loan for $200,000, then they want your dwelling limit to be at least $200,000. That way, the bank is gonna feel safe knowing that even if the worst thing happened to your home, at least their loan is safe and they're gonna get paid out for at least the amount that they lent to you. Now, if you have your own free choice of determining how much insurance you want, then there's 2 real ways to think about it. One is how much it would cost to rebuild this home from the ground up if a major disaster happened. For example, if there was a huge fire and the whole home went up in flames, how much would it cost to rebuild that from the ground up? Now, another way of thinking about it is maybe only get enough insurance for the structure's value so that if the home burned up, you could get a check for what the structure's worth and then sell the home, the land as a burned out shell. You probably won't get as much money as you could, but the amount that you get from the sale of the land plus the check you'll get from insurance should be enough to cover all of your losses from the home. Basically, you want to account for a worst case scenario and insure the property for as much as you think the property's worth. Now, the next thing we're going to talk about are the 2 ways that insurance companies are going to pay you out. The first method is called the actual cash value, and the second one is called the replacement cost value. Actual cash value is when an insurance adjuster will come to the property, take a look at it, and pay you based on what the property was worth when it was damaged. So if you had an old roof that was on its last legs, then you may only get a few $1,000s to repair the property, even though it'll cost over $10,000 to get a brand new roof. Whereas replacement cost value would pay you the full amount to replace the roof. Now, since replacement cost is going to be higher than actual cash value, these policies are also going to be more expensive too. So you have to make the decision. Do you want to get paid based on the replacement cost or on the actual cash value? We tend to go for replacement cost value on more expensive properties and actual cash value for cheaper properties. And I'll share why in a little bit. So here's how we look at insurance. I only look at insurance for absolute worst case scenarios to protect me from a major downside. But most of the time, I just pay any repairs out of my own pocket. Because another factor that goes into your insurance policy is something called your deductible. The deductible is how much you have to pay before insurance kicks in. So if your deductible says $5,000 per occurrence, then for every major disaster that happens on your property, you would have to pay $5,000 first, and then insurance would come in and pay for anything else. So for example, if I had an issue that costs $8,000 to repair, then I would have to put in $5,000 myself, and then insurance would come in and pay me the other $3,000. Now, of course, this may seem like a bad deal, but the higher deductible that you have, the lower your insurance premiums are going to be. So just think about your situation and think about how much you can stomach paying on a per incident basis. And again, we typically go for the highest deductible options because we only use insurance for the absolute worst case situations. And on top of that, every time you make a claim, your insurance premiums will go up for all of your policies too. So we try not to file claims unless you really have to. Now, if you're looking at buying a home and you're being asked where you're getting your insurance from, it can be overwhelming finding the exact place to find your policies. And before, I would go online, research a bunch of different companies, get on phone calls with multiple insurance agents, and it was a huge hassle. But lately, we've been getting our insurance policies from one place called Steadily. Steadily is a real estate insurance broker, so they're going to be able to go out and find the best policies for you. And since they're a brokerage, they may even be able to get you broker rates on some of their policies, which means that you may get a cheaper policy than if you went to that same insurance provider yourself. Now, I really like using Steadily because they have an easy to use and user-friendly interface where all you have to do is type in the property address, type in some facts about it, and after a few minutes, they're going to spit out a quote for you. And better yet, they're going to connect you with a live agent, so this live agent can actually talk to you about the policy, answer any questions you have, and even make adjustments to it so that you get the right insurance policy that's right for you. So if you're looking for home insurance, definitely check out Steadily with the link in the description. So now that you know the basics of how home insurance works and where to get the best policies, let's get into the nitty-gritty details. When you get insurance on a property, they're going to ask you several questions, like if it's an owner-occupied property, a vacant property, a short-term rental, etc. And the reason they ask you these questions is that naturally people who own the properties are going to take care of the home better than tenants are going to be. And people who live in the property long-term with long-term tenants are going to take care of the property better than short-term tenants are going to be. And a short-term tenant is going to make sure the property is at least in livable condition compared to if the property was vacant. So these different occupancies are going to determine how much insurance you're going to have to pay. Now, make sure you answer this question truthfully, because even though it costs more money to get an insurance policy for a short-term rental instead of an owner-occupied rental, if you have a policy for an owner-occupied rental and a major accident happens and you find out that it was being rented out as a short-term rental property, then these insurance companies may not even pay you out at all. So again, be very truthful and get the policy that is actually for your situation. Having insurance can be very important for you, especially if you're running real estate as a business. For example, we had a friend who was running Airbnbs for a client, and during the time that the property was vacant during the winter, the pipes actually froze and bursted. And since the property was vacant, no one noticed the leaks for several days. And by the time the cleaners came in to do their job, they noticed the whole place was completely flooded and the property was basically damaged to no end. It couldn't be rented out, it couldn't be sold, so the owner had to take down their listing and do all these renovations. But luckily, because they had insurance and they had something called rent loss protection, they were able to continue getting paid their Airbnb rates for an extended period of time because of this accident. Now, one thing I want to do with you guys is share a quote that I have for one of my properties. So our policy for the year is $1,509.98, which I think is actually kind of high. So I might call my insurance provider later and ask for a better quote. And it's broken down in several ways. So we have our taxes here, we have our dwelling, which is for $1,355, and we have our liability premium for $111. And let's see how that breaks down. So if we see here that this is an older home, built in 1945, it's actually a pretty small home. The limits here are for $183,000, and this is replacement cost value. So our premium is kind of high here. And again, because it's a smaller property, I may call them and ask for this to be actual cash value instead of replacement cost. And hopefully that brings this number down. But since this dwelling limit is $183,000, that means that for any major damage that happens, the most I'm going to be paid out is $183,000. So one way to reduce your premium here is to ask for a lower dwelling limit. Like if I don't think this property really is worth $183,000, then I can ask, hey, can I get the limit for $150,000 and see how that changes the number here. You can see here that this policy also covers other things that's just included in the premium, such as, other structures. So this is probably like the garage or like a shed in the back. We have personal property here. So if something happens, like say I have some jewelry in the property and gets damaged because of an accident, or maybe it gets stolen, then here I get $3,000 here. I have loss of rental income. So up to $19,000, for some major incident. Like if I had a fire in this property and it's a rental property that lasted over a year, then they might pay me this full amount because I lost this amount of rent. Same here, if there's any water damage on the property, that's $18,000. So maybe there's like a leak from pipe or something and it ruins our whole roof, then we get paid this amount of money. Mold or fungus, $5,000. There's a thing here called water backup and sump pump overflow. So this is not very common, but if there's like a major flood from a sewage and all the water goes up your sewage, up your toilets and flood your house, then that's where this would come up. But again, I don't think it's that common, so I didn't opt for it. You get vacancy extension, builder's risk. This is mostly for properties that are vacant and you're doing basically a home new remodel or flip. This is where this number will come in. So as you can see here, there are some things that it excludes, like terrorism, floods, or earthquakes. So that's a risk, again, I'm willing to take. In this area, there aren't too many earthquakes, floods, and we hope there's no terrorism attacks. So down here are the deductibles. And you can see here that I'm spending $5,000 per incident before the insurance kicks in. So, if there's any like small issues, then I'm probably gonna cover it myself. Probably up to like $15,000. I wouldn't get insurance. It's not worth my time to go through the insurance process. I'll just pay it myself. Over here on the right, you can see the liability coverage. So general liability is gonna be $1 million. This probably could be a little bit less, maybe 500,000. But again, it's not that much premium. It does keep us safe from any lawsuits in case someone gets hurt on our property or something, or something like that. So what happens if you have a huge accident and you do need to file a claim? Well, that's when you go back to your insurance broker and have them help you talk to insurance companies. By talking to your broker first, they'll know the right lingo to talk to your insurance provider for, because you don't want to be caught in a situation where you're saying too much that gives the insurance provider enough ammunition to cancel your policy or not pay you out. They'll help you file the claim, and then an insurance adjuster will come to your property, check out the damages, then they'll either give you a check or they'll pay the contractor directly to fix the property for you. Now the thing is, this could take several months, so it's always good to have emergency funds in case you need to do repairs yourself ASAP. Because I've seen a situation in my own backyard where a property burned down because of a loose electric cable and it took them 2 years to get paid out. So during those whole 2 years, that property was just sitting there empty. So finally, here are some mistakes that you need to avoid when getting insurance policy. I think the first mistake is going for the very first policy that you find. It is worth your time to shop around, because by doing a little bit more searching, you might find another policy that saves you more money, that gives you more coverage. Another mistake that's common for people is not having the right start date. So you want to start your insurance the day that your property closes. And if you're telling your insurance provider that you might start at a certain date, something happens down the line and it pushes your closing out, make sure you tell your insurance provider. Tell them that, hey, we didn't actually close on this date, we closed later. That way they can adjust your dates and give you a partial refund for the unused time. Another mistake is paying for too much for things you don't actually need. So again, talk to the insurance provider or broker and let them know your exact needs, and they'll be able to give you a policy that fits you so you get the right price and the right coverage. I think another mistake that people have is thinking that once they're with one insurance provider, they have to stick with them forever or at least for 1 year. And in actuality, you can change insurance providers anytime you want, and they're even going to give you a refund based on the unused portion of it. So if you only use a policy for half a year, then they're going to give you a refund for the unused half of the year. If you're ever unhappy with someone or you find there's cheaper rates, just switch. There's literally no reason not to. So now that you know everything you need to know about insurance, you can get the one that fits your exact needs. And if you want to save big bucks on your next insurance policy, then start your search with Steadily with the link down in the description, and be sure to check out this video where I tell you all of my tips on how to save money on getting insurance. Thanks for watching, guys. I appreciate you, and I'll see you next time. Take care.